Hi everyone, it's Jack back with another video, and today I'm going to be doing a 5-minute stock analysis on online real estate company Redfin. It's down 80% year to date, which is absolutely staggering. Has a 52-week high of $65, now just shy of $8. Absolutely brutal. Of course, a higher interest rate environment undoubtedly hurts the real estate industry in general, particularly Redfin in the short term, but I want to establish what its long-term prospects are. Redfin essentially tries to get a better deal for sellers, selling homes faster. 88.3% of listings sold in 90 days compared to 86% for the wider industry. To get more money for each home's price premium for a 2,000 square foot home was greater than $1,600 versus the rest of the industry, and charging less, they have a 1% on average listing fee compared to an average of 3% for the rest of the industry. This is very succinctly summed up by their mission to redefine real estate in the consumer's favour. You know, real estate agents can take high commissions, it can be an uncomfortable process, it can be time consuming. Redfin is working to get away from that. It's the number one most visited brokerage site with nearly 4 times the amount of traffic than the second largest brokerage website, which is absolutely outstanding. They've made more than $1 billion in cumulative customer savings across 400,000 transactions. They aim to remove friction with their technology at every step. They have their own agents, which is a strong vertical integration, end-to-end product offerings, and they've carved out decent market share for itself in a very, very large, attractive market that is ripe for disruption. $112 billion core market, assuming 5% commission on the existing home sales data. There's 136,000 US brokerages that they are working to outcompete essentially. This really is a jack-of-all-trades real estate business. They offer a popular listings website, which of course is what it's best known for, which includes a platform for renting and for renters. Mortgages is now offered since 2017 with significant acquisition of Bay Equity that decently expands the capacity going forward. Title and escrow services, which has been around for a while, now in 27 markets and 13 states. Concierge service, where they can give a 1% fee and they'll do cleaning and things like that in the home. And all of this is without mentioning Redfin Now, which is launched in 2017 to be in 30 different markets, and this is their iBuying segment, which of course has got a lot of publicity because of what happened to Zillow and how it was significantly declined, and there was a massive stock price decline. How they got in and got out of iBuying because they made a mess of it. And this is also a place of competition with Opendoor, the famous Shamath SPAC. So it's a contentious industry, or whether this is going to work or not is very capital intensive. How does this affect the most recent results? Well, they did $597 million in Q1 2022 revenue, this is the most recent report, up 123% year over year, which is quite impressive. Also, that is more revenue than they did in the entirety of 2018 put together. You also have to take into account this is a very good housing market right now for a company like Redfin, not necessarily for buyers or sellers, but exceptionally good for Redfin. Even with that, only 12.1% gross margin for 2022, which is not very impressive. Significant decline from the year prior, and this has been declining for the last three quarters. This is very worrying. Not to mention an increased net loss of $91 million, tripling and more from the previous quarter, almost as much as the previous year put together. Again, very worrying as they ramp up the iBuy and blah blah blah, but this is not a very good news for Redfin going forward. The next quarter outlook was decent, considering the environment is about to get a lot tougher for companies like this with an increased interest rate environment. Home buying and the housing market seems to be slowing down. Year over year revenue growth of between 30 and 38%, while a significant decrease from the year prior. You're going from excellent market conditions for a company like this to not very good market conditions, so that's okay as far as I'm concerned. Nice year over year growth in the properties of 48 and 63%. Increasing compared to Q2 of the gross margin, which is exactly what I want to see. Unfortunately, the net loss is looking to, decrease from the first quarter, but still significantly higher than what we're expecting the previous year. $72 million loss on the low end and 60 on the high end. This is not very impressive and going in the opposite direction to what we want to see. In terms of pros and cons, or bull and bears, pricing advantages versus traditional real estate, this is obvious. 1% fees is very strong compared to traditional real estate. The vertical integrate, which makes it a much more harder business to disrupt. Huge potential market, total addressable market of well over $100 billion is really strong and a lot of space for this company to grow into. And they're not only maintaining the market share, but they are gaining it, and they have a really strong lead over competitors in this industry. iBuying On the other hand, iBuying is very capital intensive, is not proven to work on a large scale. I'm interested to see how Opendoor reports soon, see how they're doing, but this is enough to turn me away from this business essentially. I don't think iBuying is going to work in the long term. We saw what happened with Zillow, we ran completely pear-shaped. They're relying on how good their algorithms are. If the algorithms aren't very good, this could go really bad for this company really quickly. Not to mention, this is inherently asset-heavy, capital-intensive business segment. They have very weak margins that are getting weaker, so from 25%, which was acceptable last year, to now 12% gross margin, just not very good. Consistently unprofitable, and net losses look to be expanding. Even with a price sales of 0.3, this business needs to start pulling in a profitability to be a reasonable valuation. Even it has came down 80, 85, 90%. It's going the wrong direction. It doesn't look like it has a clear path to profitability right now. And this is going into a potential housing downturn and recession. None of these are good for Redfin in the short term. However, over the long term, I think this business has the potential to be really strong in the real estate business, provided they can sort out the iBuying segment. With that being said, none of this is financial advice, and you should not take it as such. If you enjoyed the video, like and subscribe. I'll see you again next time.